Today, I want to help you understand, are real estate interest rates going down? That is the question that is on the forefront of most real estate investors' minds. By the end of this video, I'm going to detail out to you some of the most important factors that will help you gauge and understand if real estate interest rates are starting to go down. Wouldn't it be nice to have a crystal ball to know what's going to happen when it comes to interest rates in the real estate market? Are you curious about how certain real estate investment strategies don't even worry about current real estate interest rates? Well, let's dive into this topic by first talking about and explaining what real estate interest rates are and how they affect investors. I'll then cover with you a real estate strategy I'm doing right now that is completely not impacted by real estate interest rates. And finally, I want to empower you with some knowledge to help understand when you might be able to predict when real estate interest rates are going to go down. If you're ready, let's go. So how do interest rates affect the economy and real estate investors? Well, actually quite a few ways. When real estate interest rates are high, it affects the affordability of what the average person can get into a home at. If interest rates are double or triple what they were 3.5, 4 years ago, the mortgage payment that an individual is going to pay is significantly more than what it was back then. We have a case study that can explain just this. If you look 3.5, 4 years ago, interest rates were between 2 to maybe 3.5%, and currently they're at about 6.5%, almost 2 or 3 times larger than they were back then. So somebody being able to afford a $300,000 home was very simple. Even a $500,000 or $600,000, that payment might have been the exact same as a payment today on a $300,000 home. So it absolutely affects availability. Plus, when it comes to investors, they're a little bit more skittish or nervous about getting into the markets when interest rates are 2 to 3 times higher than what they were 3.5, 4 years ago. And obviously, when real estate interest rates are low, more people are buying because they can afford more, right? If people can afford more, that typically means that there's a large demand in the market, which means that prices start to go up. But when interest rates are high, the demand is less because less people want to get into real estate because of the higher affordability of getting into a piece of property. So you'd think that demand goes down. We're in a very unique situation in the world today, in the economy in the United States, where interest rates are high, but demand is low, while at the same time prices are remaining high. That is because supply, inventory of houses on the market is still extremely low. There's not a lot of inventory sitting on the market for people to buy. So as of today, December 18th, 2024, current interest rates for a 30-year fixed mortgage is 6.5% roughly. On a 15-year fixed mortgage, it's about 5.85. If you contrast that to what it was 3.5 years ago, many interest rates were below 3%. So obviously interest rates affect most real estate investors, but what if there was a strategy that had little impact on real estate investors? And I feel like I've come up with that strategy over the last 12 months, and it's something that I call cash flow flipping. And it is absolutely independent of what is happening with interest rates in the economy. Because here's how it works. I'm looking for properties in the Midwest that are between $50,000 to $100,000, and I'm getting them about 25 to 35% below asking price. Because of that, I'm not having a ton of accepted offers, but I'm borrowing private money and utilizing that money so I can make a full cash offer, and I'm closing quickly, right? So if somebody's offering a home for $70,000, I'm trying to get at $50,000. And are they willing to come down to that price? Maybe, because I can close quickly and I can give them cash. They don't have to worry about me getting a bank loan. Well, at the same time, I'm borrowing money from a private money individual between 8 to 12%. But let's just say I borrowed it at the highest rate at 12%. I'm going to pay interest only on that loan. So 12% of $50,000, $6,000 annually, my monthly interest only payment to the private money investor is $500. Now, I go and I sell this property utilizing a lease option, which means that the buyer is buying it from me and they're closing on the property at a certain date at a certain price down the road, and they're buying it from me at a certain price. And that price, I'm typically trying to get it at the original asking price or a bit higher. So let's say they've seen it on the market for $70,000. I'm selling it to them for $72,000. They see that and they're thinking, if I can purchase this home at $72,000 2 years from now, that's a win situation for me as the buyer. And matter of fact, they have to pay me an option price to secure the home at that price at that date down the road. And that's typically 2 to 7%. But let's just say they pay me $2,000 for the right to buy this home for me at that price down the road. And I can utilize that $2,000 that they pay me up front towards their down payment. Now they're going to pay me a rental lease every single month, and let's say that's $1,000. Another unique thing about a lease option is I can count a certain amount of that monthly payment towards their down payment as well. Let's say that I'm counting $100. So $100 a month over the course of 24 months is $2,400 plus the $2,000 they paid in that option price. They have baked in already $4,400 towards their down payment and closing costs because they're engaging in a lease option. So let's run through this scenario. I'm receiving $1,000 a month. I'm netting $900. I'm paying $500 a month to the private money lender. So I'm netting $400 a month that I'm cash flowing. And then at the end of 2 years, when this person buys a property from me, they pay me $72,000. I take $50,000 of that. I pay off the private money lender. I pocket $22,000. Well, let's call it $20,000 because I'm obviously paying some closing costs. So over the course of the year, $400 a month times 24 months is going to be $9,600 plus $20,000 that I've made when I sell the home. That's almost $30,000. What if you did that on 10 homes? $300,000. What if you did it off 100 homes? That's $3 million. That's why this strategy is so impactful. And I don't care about interest rates because I'm cash flowing and I'm building wealth. It's an amazing strategy. So what are some ways to predict if interest rates are going down, right? If you're one of those people that say, I need interest rates to go down, well, obviously market conditions. If the Federal Reserve policy says something like, listen, we need to lower interest rates, chances are the next meeting they have, interest rates are going to go down. If the economy starts to slow down, if GDP goes down or unemployment goes up, chances are there needs to be something to stimulate the economy. One of the best ways to do that is lowering interest rates. Also, housing market trends. If there's a surplus of homes on the market, with little market demand, they might lower interest rates to try and stimulate more interest in homes. But what do we know about the market conditions right now and what's going to happen in the future? Are prices really going to go down? I did a little bit of research and they are expecting a 30-year fixed mortgage to stay almost the same through not only 2025, but also 2026. I know some people were hoping that interest rates might come back down to 4.5%, but based on the research that I've done, it doesn't look like that's going to happen. Here's what we do know. Over the last few years, analysts have been predicting lower mortgage interest rates to happen because they also thought we were headed towards a recession. And one way to get out of a recession is stimulate the economy with lower interest rates. But the fundamentals of our economy just don't appear to be heading towards a recession. Employment and GDP growth is actually exceeding some expectations. I know there's periods of time where those were going down, unemployment was going up, GDP was going down, but they've been outpacing expectations recently, resulting in these higher long-term interest rates. So are interest rates going to go down? Probably not over the next few years, at least on all the research I've seen. I understand that that might affect some people, but if you are interested in the strategy I talked about, cash flow flipping, I've got a full video where I talk about 10 to 12 minutes exactly about this strategy and how you can do it as a real estate investor. Just click on the video below. This is a strategy that works in any market condition, regardless of what interest rates are doing. Thank you for stopping by. Have an amazing day.